You're about to join Jerry Parker, Moritz Siebert, and Niels Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Jerry Parker, Moritz Siebert, and I, Niels Larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rules-based investing, and of course, where we also take some of your questions. But today, we're going to deviate a bit from our usual format because we are delighted to be joined by a very special guest, namely Andreas Clenow, a true trend-following author, trader, investor, and a good friend of the podcast. And so let me start by saying welcome to you, Andreas, to the show. And as usual, let me say good morning to you, Jerry, and good afternoon to you, Moritz. Hope you're doing well today on this Sunday.
Thank you. Great to be here.
Hey, guys. Good morning. Good afternoon.
Good morning. Yes.
Hey, everyone. Now, of course, it's really great to have you on the show, Andreas. We very much look forward to diving into your world and what you've learned from the many years in the trend-following world, but also from trying and practicing a lot of other ways of extracting profits from the markets. But before we do, we normally just do a quick review of the past week from the lens of a trend follower. So while you have an extra sip of your coffee, we will quickly go through some of the highlights from last week. I hope that sounds good. Now, of course, Jerry, Moritz, in order to make as much time with Andreas today, let's do a quick roundup. From my point of view, anyways, there wasn't much that happened this week. Of course, the S&P, as usual, up a little bit in the first full week of 2020. We saw a little bit of a reversal in the energy markets as we had a kind of a de-escalation of the tension in the Middle East, at least for now. And of course, there were also some other small moves in the markets, but generally kind of a lower tension meant a little bit lower risk on, and certainly in the energy sector. Moritz, I always come to you, as you know, just to hear how your week was. Anything that stood out?
So weak. I think what has stood out is I got longer in crude. It's a long position that I already had on, but due to last week's Friday's event and the spike higher, I opened up another long position, which immediately I started to regret because, like you were saying, it's been mean reverting and been selling off. So the crude position is at a loss. At least the new one, the older ones are still doing fine. I also got a bit longer in gold. That's a nice position to have. I had it on for quite some time, but it's made new highs, and I've become longer. So that's good. And, the week was, like I said, so. I mean, the bonds, I'm still long. They rallied. And then, when kind of like the noise of the risk and all the uncertainty about that problem in Iran calmed down a bit, the bonds didn't really sell off that much. They kind of like stayed where they are. So that was good. And the equity markets, I mean, we've been repeating this for weeks. It is absolutely fascinating how relentless and how strong they are these days. So being long the equities is the way to go. I think I made about 1% last week. So fine with that. Good start to the year.
Absolutely. As we talked about last week, Moritz, if you do that every week, you'll have a great year. So keep it up.
Definitely compounded 1% per week. Ha, ha, ha.
Disclaimer. Anyways, kind of similar picture on our side. Certainly, I think we eked out a little profit for the week overall. Equity sectors did well. Currencies did okay. Some of the smaller commodities did also all right. Live cattle, actually, I see, and cocoa was okay. But, the losses that we did see also focusing on the energies, probably a little bit net loss in fixed income, but nothing major. So, still hanging in there in the new year. What about you, Jerry? Single stocks, any other markets that stood out on your side?
Well, I think what's sticking out on our side, and what I'm enjoying seeing is the rallies in the commodities. I mean, it's kind of amazing. Our shorts, we're getting out of our shorts, and we're either getting long, almost long, or we are already long with a small winner or a small loser. I mean, I think the crude thing, I got went a little long crude and then small loss. I mean, it's a material, it's kind of a big day and a big crazy move, but still, it's probably going to go back up. And but I'm seeing sugar and of course the metals, and it's kind of interesting to see that there's some strength in the commodities and the individual commodities, wheat, bean oil. Yeah, so that's what we need. We need some large trends in the commodities, which is not happening in a long, long time.
Absolutely. But as I said in the beginning, we are, of course, very fortunate to have Andreas with us today. It's been a while, actually, Andreas, since you were on the podcast as a solo interview, but it was a very popular episode, I remember. So I think there's a lot of our listeners that have looked forward to for you to come back. And of course, there might be still one or two listeners who have not come across your work. You never know. So I think maybe as a framing of our conversation today, I don't think it would hurt to maybe for you just to go back a little bit, talk about, briefly kind of your own background, and maybe perhaps also, what were some of the key influences on your own career and that impacted you to kind of steer you in the direction where you ended up going and where your journey has taken you. So why don't we start with that, and then we all will have, I'm sure, lots of questions, and you might have some topics you want to throw out to us. We'll keep it pretty casual. So maybe we just start with a little refresher about your own background, Andreas.
All right, sure, sounds good, and thank you for having me back again. It's been far too long. I was looking up before in my email threads when I met either of you guys last, and you I met in I think half a year ago, but it's been a couple of years since I was on the podcast. I saw Moritz 5 years ago, and I ran into Jerry briefly 2 years ago. So my background, that's a big question. Where do I start? Well, first of all, I'm the first to admit I'm a lucky monkey. I was in the right place at the right time, a few different places, a few different times in my life that turned out to be, critical for the long-term development. I guess the first time I was pretty lucky, right time, right place, was I was, everybody claims to be, I was into computers before it was cool, so to speak. I was one of those computer guys in the 80s, early 90s, when you kept those things quiet. You didn't speak about computer knowledge back then. Suddenly, I remember it being at 95, 96, probably 96, when the big dramatic change came, when computer knowledge turned from being some sort of semi-embarrassing hobby to a commercial negotiable asset. And suddenly everybody and his grandmother wanted to be in computers, and nobody knew anything about it. And the few of us who actually knew it since before, people were just throwing money at us for doing stuff that we all thought were really simple, and frankly they were. So I started my first computer company back in, I think, 95, maybe 96. It's been a while, I'm getting old. I was running that for a few years. It was fun times. It was in Sweden, obviously, which was, hard to think these days, but it was a bit of the epicenter of much of the IT development at the time. That was fun for a few years, but I had this nagging feeling that it wasn't the grown-up thing to be doing. I think 99, 2000, around there, I just graduated business school, Gothenburg. It was time to try something grown-up, so I got rid of all of this stuff. Had no foresight at all about this whole industry coming crashing down. I just exited at the right time, pure dumb luck. I got a grown-up job, so to speak. I had a grown-up job for 5 years and never again. It was fun for a while, but it didn't really fit my style and personality. I was middle management at Reuters, the financial information company that, depending on your point of view, either no longer exists or have changed name. They changed name, 3-4 times since I left them. I spent a few years there, and I realized it's not really what I want to be doing for the rest of my life, moving headcounts around the world and sitting in endless teleconferences discussing projects that probably never happens, and project managers and product managers and program managers and whatever they're called, and it's just bureaucracy and paperwork and nothing ever gets done in the end. That was my... I don't think that's specifically for Reuters. I think this big company, and some people have personality for it and some don't, and I think while I figured out how to rise in the ranks, I also figured out that the more I rose, the less fun it was, because the less actual real things you get to do and the more time you get to spend in teleconferences discussing headcounts, and not really what I want to do.
Sure.
Guess I got lucky again when I left. I was in a state where I just felt like I had to get out of there before I get institutionalized. I realized that if I stay too long, I become one of them, and that's not going to work out. So I left. I was very lucky, as in I had some investment strategies, I had some ideas on what to do, and I kind of accidentally run into some people who had, sounds small now in hedge fund space, but they had about 50 million to invest, and they needed somebody to actually do it. They had some ideas, but they needed somebody on the ground. They needed somebody to actually sit in an office and get it done, and they needed my strategies, my computer knowledge, and actually getting stuff done, and fit me perfectly. And people keep asking now, how do I replicate this? How do I want to get into the business? How do I find this? And I don't know. As I usually say, I slipped on a banana peel and I landed in the hedge fund business. So that's how I got into the sharp end of asset management, really. Next lucky point, I guess, I got into trend following at that time, and that must have been like 2005, 6, around there. Mm-hmm. And as we all know, in trend following space, that was a pretty good time to get into the business. Everybody else got in 2009 after the stellar year. But having been lucky enough to get into the business before I got to experience some of the great profits that we all saw during that time, and it's hard to claim that it's skill. I picked a strategy that happened to work great for the next few years. So that was a great fun ride. Having been in at the right time. Also, on the theme of luck, back then starting a hedge fund here in Europe was not particularly difficult in terms of regulatory environment. Nowadays it's a nightmare. Nowadays it's considerably more expensive. You need considerably more capital. It's a whole different ball game. The barriers of entry have gone up dramatically, but I got in just before they changed. So it's a fun ride, and I mean that leads me to, of course, long story. What do I do nowadays? A lot of stuff. I find it difficult to explain even to people in the business what I do for a living. We do a lot of stuff. We do some systematic models. We allocate a lot to other hedge funds. As you know, some of you have been in my office pitching investments. We do various private equity projects. We do some securitization of some ventures that we are running, especially in the States. We have some funds, and we try to concentrate on doing different things. As in staying out of the crosshairs of the big guys. I don't want to go compete with David Harding. That doesn't sound like a fun thing to be doing. I know who's going to win that contest, and it's not going to be me. So I want to do something different from what the big guys are doing. And Jerry, I include you in the big guys, so I don't want to go head to head with you either. I'd rather stay out of your way and do something slightly different than you guys and pitch something unique that the multi-billion-dollar guys don't do. Yeah, brief summary. I'm not sure if I missed something. Yeah, brief summary of who I am and what I do anyway. I wrote a couple of books along the way as well, as you know.
You certainly did, and I'm sure we're going to make reference to them today. I have a feeling that we might stay focused on one of the things you've done in your past, at least for a while. But why don't we just kick it off? I don't know about you, Moritz, if you want to just dive in there with some of the things you thought about as we were preparing for Andreas to come on board.
Yeah, sure. Hi, Andreas. First off, great to have you on our show. Looking forward to having a bit of a discussion with you. We all know, I mean, we know each other, and also the books that you wrote. We know that you are a fan of systematic trend following. And I just wanted to ask you if, in addition to trend following, you're running any other strategies, non-trend strategies in a systematic way. I'm not talking about all the discretionary stuff, which may be venture capital or private equity related, but systematic type of trading models which are non-trend.
Yeah, we do some. It's always a matter of definition in the end. What's trend and what's not, and sometimes it's clear and sometimes it's not. I am a fan of combining different type of models, as in models that sound counterintuitive to combine, but can actually have a benefit when you do combine them. Like if you run mean reversion models on a shorter time frame and combine them with a long-term trend following, you can get quite nice complementary return. You can get better risk-adjusted return by doing such things. I'm also a fan of various type of term structure related models, as in trading the implied yield of the term structure either outright or as a calendar spread type of model, but simply basing models not on historical data but on the difference between points in the term structure can be a very interesting type of model in my view.
Okay, understood. Thank you. Niels and Jerry and I, we are pretty pure in our way that we trade trends. When you add some other models to a trend portfolio, such as mean reversion, how do they relate to each other? We know that mean reversion strategies, they definitely have a different distribution, more left-tailed than the trend type of stuff. In general, well, I'm not sure exactly how your mean reversion models work, but how do you go about this? Because, it's very different to trend where, we have many losers, the occasional winner that, then has a very long right tail. Whereas mean reversion has, for the most part, I guess, a lot of winners, very small winners, and the occasional loser, which is then a very heavy loser.
Absolutely agree. First of all, I don't think there's anything necessarily wrong with negative skew strategies, as long as you're very aware of what you're doing. I'm not a big fan of trading them myself, but I see no problem. I invest in some trading models that definitely have a severe hidden negative skew. But as long as you're aware of it and you've done the math and you're happy with the risk distribution, I think that's perfectly fine. I'd also say that there are different types of mean reversion models, meaning that you don't necessarily want to try to pick absolute bottom or tops. If you see the mean as being the trend, for instance, and what you're really trading is dips in the bull market or vice versa on a bear market, it's not necessarily a negative skew type of strategy anymore. You do have a different return profile than you do in trend following. You have different distribution of winners and losers. It stands pretty fine alone as a model. It can hold its own as a model if you do it right. But I find it even more interesting combining with the trend model, because you get different timings on the highs and the lows of the actual return. And the interesting part with combining it, I always thought, is that it might make sense for an investor, but not necessarily for an asset manager. The point there being that if you're marketing a strategy, if your main goal is to raise money and market a hedge fund vehicle or trading strategy, you might have a difficulty explaining a combined model. And if you're pitching it to a CIO of a larger, say, family office or a pension fund, you might also run into the problem that you're trying to do their job for them. The CIO of the large pension fund is going to say that, well, you know what, you're pitching me a combined strategy of two sub-strategies. I like one, not the other. And besides, it's my job to tell you, what allocation I want of each. That might cost you a ticket if you're pitching to the big guys. But if you're doing it yourself, or you're trading your own money, or you're trading your money that's close to you, or, sticky money anyway, it might make a lot of sense to combine models for better risk-adjusted return in the long end.
Yeah, just following up, I think that even if you're sort of committed to more of a pure trend approach, at least from my point of view, it's basically, I still understand how all that is true, and how I wish I had a shorter term or a mean reversion or something that was different to the long-term trend following, I know it would be a fantastic addition. So the way that I've approached it over the years, sort of thinking, well, I don't know if I can be successful in coming up with something different and complementary to trend. I'll just be kind of ridiculously intense on adding different markets and single stocks. And so where I thought the indices might be a little bit more correlated with each other, so being able to go through and look at thousands of stocks and maybe pick out 30 or 20 that are a lot different, hopefully, and then they become more different if you overlay the trend following. That's what I sort of have done. And then, of course, adding to the markets that everyone else, all the other CTAs trade as well as they've become available. But I can definitely see how, if you're able, that's great to add other things to your approach. So anyways, I've enjoyed over the years reading your books and listening and podcast and reading articles. And so I really enjoyed that one book, probably the first book of yours I read, where you talked about trend following and sort of figuring out ways to replicate how some firms traded. And I thought that was really cool. And so recently when you had your interview with Meb, I loved that interview. It was so good. And then it was a little bit, so I tweeted a lot of your quotes from there, and a lot of my Twitter followers, they love your books. And so it was really a popular group of tweets. But what's great about you is we don't always agree. And sometimes I don't really understand. So that's where I'm going with my questions this morning, to sort of see if I can understand better and offer some alternatives to, I think, in areas where you and I don't see eye to eye. But one of the quotes I tweeted was, I think this is from you: trend following is very much a portfolio strategy. To run trend following on a single market is just begging to get hit badly. Trend following is about taking a lot of bets on very large number of markets independently. But then you say risk is a matter of valuation change, or I'll say valuation change per unit of time, or potential value change per unit of time. If those components are not in, it's not risk. Risk per trade I find to be a misunderstanding of what risk is. And then I say, my comment is risk per trade is all that I've ever used. So can you sort of explain more how you don't like taking, when I think of trend following, we're taking these small losses, and we're like you say, we're in lots of different markets. We're long, we're short, commodities, currencies, stocks, for me, single stocks, interest rates, taking these small losses. And then once we get kind of a profit in a trade, palladium or emissions, they've been some really good moves this year, and the bonds, we sort of like use that as license to sort of say, hey, forget volatility, forget traditional standard deviation and risk measurements, because it's now a profit. In order for long-term trend following to be profitable, I've got to let it go, let it run, don't get out too quickly. And I have this freedom now that it's just a profit. That's the only criteria in my mind, that I can kind of be more risk averse. Whereas on the original trade, I'm trying to lose 50 basis points max of my AUM. But if it's a profit, 50, 500 basis points, who cares until my trend following exit gets hit?
Yeah, I guess I deserve to get beaten up on that one. No, I mean, of course, you have to understand that when I say stuff like that, you're not actually the target group here. The target group that I'm trying to say these kind of things to are the retail traders that I often see make massive mistakes in understanding the very core concept of risk. There's so much odd things out there, odd misunderstandings about risk. And sometimes you have to push it a little bit to make a point. I think most people who are not familiar with, say, traditional view of risk, that is the financial market type of risk, where you look at volatility, you look at stress testing, you look at VAR measurement, these kind of things. You can say, is it useful for everybody? Maybe not everybody. But is it useful to understand it? Certainly not. Certainly useful to understand it? Certainly yes. Sorry about that. Point being, a lot of people come from a point of view where they've only seen the retail technical analysis money management view of how to allocate money, and they come with a very skewed or very limited view of what markets are. I mean, you clearly understand proper risk and what proper risk is, and you have good reasons for working, in a different way that fits your portfolios. Very different thing. What I have a problem with, or well, not a problem, what I'm trying to teach people really is to open their eyes to how risks tend to work on the professional side and what they can learn from it. The problem is a lot of people in the retail community, and I'd say people who listen to me, people who read my books are probably, well, what do I know? I'm guessing maybe 70% retail, I'd guess. Frankly, I don't know. They tend to work with methods sometimes that bothered me, both in risk, how to look at risk and how to look at return. I see that the large majority of private traders end up losing, if not all, but enough money to stop or reevaluate. They listen to various, gurus selling them some snake oil somewhere, who talk in terminology which is so far away from the market and so far away from any sort of professionalism. Sometimes, you gotta make some statements to get people to pay attention and to look at the more proper risk measurements. Now, risk per trade can be a dangerous thing if you don't understand what you're doing. If you simply say, I'm going to risk $1,000 in a trade, if you're a retail guy, what does that mean? Is it $1,000 in the next 10 minutes? Is it $1,000 in the next 10 weeks? This year? Those are absolutely very different things. There should be some sort of time component, even if that time component is not exactly defined. Most of the time it is, in my experience, on the professional side. I understand you work differently, and it worked great for you for, 40 years? So who am I to argue with that? But you probably have some sort of time frame in mind. When you say you take X risk per trade, you don't mean that's open for as little or as long time as it takes. Like if it takes a year, it takes a year, right? Or if it takes 10 seconds, it's 10 seconds. You probably have more or less a time frame in mind. So it's just a different way of looking at, more or less the same thing. I would assume in the end. But I mean, I think you understand what I mean here. That if you look at normal quantification of financial risk, you're looking at some sort of understanding of volatility. That you can't just assume that because I have a theoretical stop loss at some point, and if that theoretical stop loss loses me $1,000, there's the same risk on any market. If you have a massive difference in volatility, you have a gap risk, you have an event risk, you have different factors to look at, and risk is a much more complicated topic. So clearly, even in my books, when I try to explain a little bit more, you can't go into real details about risk, but you can try to explain the concepts. And I think that's beneficial to most people out there who have little exposure to it.
Yeah, one of the things that's been a lot different over the past 15 or 20 years is the European CTAs introducing vol targeting and disagreeing with me essentially and saying, no, the volatility and the standard deviation does matter. Clients think it matters, so we think it matters, and we're going to adjust our systems and get to a new higher level than old turtle trend following and that silly, simple stuff. And we're going to do sort of a constant vol targeting. And so I've been sort of anti-vol targeting because it seems to me that it's sort of can overwhelm the systematic approach and the sample size of your backtest. And if you're do a backtest and you evaluate your system and its sample size based upon entries and exits, but then the vast majority of the trades are these daily or weekly vol targeting trades, it kind of overwhelms the system and the back testing, and it's just I think it can help you take small profits, versus letting your profits run. So I didn't know if you had looked into that, if you were a fan of more managing the equity curve in that particular way as a part of a trend following system.
No, I mean it's a tricky one. It all depends on what your purpose is. I'm not a big fan of vol targeting per se, but it depends on what you're doing. Now, I believe in today's world, and I think this is what you're implying as well. I mean, if you're aiming to run a very large portfolio, you're pitching to the big guys. You're pitching for the 30, 40, 50 million ticket sizes of larger players. You're going to need vol targeting, I believe, going forward, for better or worse. I'm not necessarily a fan of it. I don't believe it really helps the long-term performance. I believe in using volatility to evaluate performance. That I think is quite important. I know some CTA funds that have extremely high result over time, but of course also they have ridiculous volatility, and you can have 20% up and down sometimes. In 2 months they can be down 40%, and next 2 months they're up 40% again, and that's a wild ride. And when you evaluate performance, you need to take that into account, in my view. But the vol targeting is a tough one. I mean, first you need a substantial portfolio to do that, to implement that in reality on a futures portfolio. I never tried to implement that on a futures portfolio. I'd say less than $500 million. It probably doesn't make any sense to look at it. I haven't seen vol targeting really enhance long-term results, but I get the point of view. I get the point of view. If you're a large CIO, you're a large allocator, you're allocating billions to various managers, you need to have some sort of predictability in your standard deviations. I get it from that point of view. It's a tough one.
I'll ask one more question, then I'll let you take over, Niels. I have a lot more, but yeah. So I know you've written some articles and books, and one of the sentences or paragraphs was something, or the title maybe have been something along these lines, which is trend following doesn't work on stocks. And so I wanted to get your explanation for that, given that unfortunately for us, stocks have been the best trending markets, and trend following has probably worked the best on stocks over all the other markets that we've traded over the past 10 years, I guess. So exactly what do you mean when you've talked about that subject of stocks and trend following?
Yeah, that's a good one, actually. This is a bunch of years ago. That's a good one. I remember you sent me a mail after that one as well. Okay, let me explain the background slightly on that one. You see, at the time, I'd written one book. I'd written a book about futures trend following. And then I was in some sort of interview. I can't remember what kind of podcast, journalist, magazine, whatever it was, but I was in some interview. They asked me about trend following on stocks. And I discussed in a high level the difference really on what I think is the differences between stocks and futures. And I didn't say a word about it not working on stocks. Then I get some mail later with some, I don't know what it was, some podcaster or what it was. I got some mail saying this guy just said that you claim the stocks don't trend and trend following doesn't work on stocks. And well, I thought I've never actually said that, but hey, why not? Let's see if I can just bring some attention to what I think are the differences between stocks and futures. So since I never before actually said it didn't work on that, but I thought, why not? So I wrote an article titled exactly "Trend Following Doesn't Work on Stocks," mostly to see if I can, turn some heads. In the article, I explained, really, in my view, it's semantics. There are some differences. If you take the exact model you're running on diversified trend following on futures, and now you run it on a bunch of stocks instead, the exact same thing, I don't think you're going to end up very well. Doesn't mean that stocks don't trend. Certainly they do trend, but there are slight differences. I want to highlight in the article what the differences are and what the pitfalls are, what to take into account when you're dealing with stocks. And therefore the headline, the slightly provocative headline. My main point, I believe, it's been a while since I wrote that one, but I believe my main point was this. If you do trend following on futures, you have a lot of different, you have a small number of markets. You have, depending on how you look at it, 40, 50, 60 highly liquid futures markets you can trade, that most people trade, with very different profile. So you have markets with low correlation to each other. You have, if you look at corn and you look at, bonds, you have limited correlation between them. Therefore, you have some advantages in terms of diversification when you combine these things. Now, if you trade 100 stocks, you have a large component of beta in there, meaning that in a bull market, they're all going to move up, more or less. In a bear market, they're more or less going to move down. And point being, since you don't have the same cover of diversification, you need to take it into account, both in terms of when you build a model and your expectations for how to perform. In a futures model, if you build it well, you can expect that probably you have a low correlation to equity markets in the end. You don't necessarily lose money when the S&P goes down, or don't necessarily gain when it goes up. But if you do a trend following model on just a bunch of stocks, you're probably going to have quite a bit of correlation to the index. It affects should affect your design of the model. It should affect your expectations for what comes out of the model. So no, I mean, I decided to use a different terminology to make a point. That was it. I have no problem with trend following working on stocks. It's simply a matter of using different terminology to highlight the point.
Yeah, what I've found is that, well, it's sort of getting back to your quote. Trend following is a portfolio strategy. To run trend following on a single market is just begging to get hit badly. So I think if it's stocks only, yeah, I mean, that's a problem. You know, it's not going to be as good as stocks, currencies, commodities, and fixed income. If it's commodities only, it's not going to do that well. If it's bonds only, you know, it's not that great. So it's not just a single market, but even a single sector. You know, we're taking that sector away. I think it diminishes the portfolio. I mean, it is kind of a bummer that the clients out there in CTA land, they want some crisis alpha. And then we're like, well, you know, I'm running a business. I have to put food on my table. So do you mind if I trade a few equities because it makes my performance better? Sometimes 2013, for instance, stocks are the only thing that's moving, and that's the only thing that's trending. So I'd like to maybe just go ahead and create this more perfect portfolio rather than always trying to meet other people's needs of a more perfect hedge. So I think that's kind of a business issue or whatever, but that's where I thought, and then of course I like to use the single names, and in the single names I think you can find some stocks that are not correlated with each other or necessarily correlated with the S&P, and then you run all of this backtest and this data and you're like, wow, these are independent markets, and then you get a crash and you're like, whoa, they're not so independent. So you're kind of sitting there thinking, well, I've got a diversified portfolio of equities. I know I'm going to get hit in a crash. Maybe they're all going to go down. So hopefully with my trend and my equities that are not so correlated with each other or the S&P, hopefully I'll be short or flat. And so I won't get hit as bad performance-wise when the stocks do crash. But this is sort of what I've come across in trying to trade single stocks for 20 years or 30 years. I don't know. I mean, from day one, I was just obsessed with this whole idea.
No, but it makes perfect sense to me. So that's why, I mean, I use the term momentum. I think in the article I said momentum works on stocks, but trend following does not, which is splitting hairs. But
what does that mean? Time series momentum or cross-sectional momentum?
Time series momentum in this case. So basically, I made a distinction in the article mainly to make the point. Point being, after my first book, a lot of people were saying, this seemed to work great on futures, but I don't have enough money to trade futures. Can I just take this model and apply it on stocks? And I said, no, please don't do that. I don't really want to, come and explain to your kids why their college trust fund is gone. It's not going to work out for you, for many reasons. But clearly there is, autocorrelation if you want to, depending on how you want to classify the phenomenon, but there's trending behavior in stocks. The problem is they all tend to trend at the same time and they take a hit at the same time. That and also the obvious problem is a related one. I often get the question as well, can't we just use ETFs then? Not really. One, because you don't have enough coverage. You can't take a commodity ETF and say that I had somebody once who desperately tried to argue that a commodity ETF containing 20 different commodities is by default diversification. Said, not really. I mean, you're long all of them or you're short all of them, so you can't really. Anyway, that's one problem. The other obvious problem with doing ETFs, even if you had full coverage of everything, is they're cash instruments. You have little possibility to get any sort of leverage on this. And even if you do, that leverage is going to be really expensive. So I'm not a big fan of running this kind of models on too much cash instruments. Getting some of them in there is perfect for diversification, but not primarily.
Take it away, Niels.
Yeah, no, I mean, I like Jerry said, Andreas. You know, your first book was you know, a very very interesting read and very inspirational. I completely forgotten, by the way. I was looking at it this morning in preparation for our conversation. I didn't even realize that you had also some comparisons to Don in there, which I'd forgotten. But of course, back then I didn't work for Don. It didn't mean anything, anyways. But it was quite fun to see that. But I decided that my questions, and I've got a bunch of them as well. We'll see how many we'll get through. I was going to try and think of some of the questions we get from our audience every week and try and put some of those questions to you. But I think maybe some of them will also be obviously tilted from just my own curiosity. But maybe just to set the scene and just again, people who listen to us every week, they hear the same. They hear a lot of the same stuff we say. We repeat ourselves a lot, I guess. So I wanted to start out with just you giving your opinion. I mean, when people talk about trend following strategies, we often say, well, there's only so many ways you can do trend following, meaning there are not that many of them. And I was just curious from your sort of big picture point of view, whether you know, the various very well-known type of trend following strategies, whether, you know, breakout, whether it be price volatility, you have moving average crossover, you have time series momentum, and maybe there's a few others. But in all of your research, do you think of them as being the same, meaning actually it doesn't really matter which one you dive into and that, you know, adopt as your child when you want to get into trend following? I think that's sort of one of the things we often, you know, get asked, you know, so what kind of trend following should I be focusing on? What's your view on that, Andreas?
I don't think the broad outline of the methodology matters that much. I mean, whether or not you use, I don't know, moving averages, breakouts, or, you know, what kind of exact method you use to define the trend, I think you're going to end up more or less with the same. There are details that can matter in the long run, but overall, say, the asset mix will matter a lot more. I mean, whether or not you use, I don't know, certain sort of a breakout or some smooth price action or whatever you use, you're going to get more or less the same thing. I mean, you know, you look at the portfolio, the holdings, the list of holdings for different managers, they look the same. What differs is mostly the asset mix differs a lot between funds. The time frame can at times differ, although it used to be that most were operating on very similar time frames before. So you have the risk level. I mean, some are running on very high risk, meaning very high volatility, and often achieving very much higher results in the long run, but, you know, at the cost of higher risk, if you want to see volatility as risk, which we can probably discuss all evening if we like to.
Sure.
But no, I don't think that matters so much. I mean, look at something dead simple. It's a test for you guys to do at home. Compare the exact holdings you would get if you run, say, your favorite breakout model or whatever you want to look at, and then you compare it to something simple like look at the price level 12 months ago and the price level today, and that's your only trading input, right? So if we're higher today than a year ago, then we're long, otherwise we're short. I mean, obviously you don't want to go trade like that, but use it as an analytical input and check the portfolio you would theoretically get, and you will see that you get more or less the same as your other models. So how big difference is it? I'd say that the diversification and the allocation, that is, you know, how much do you buy of each and which markets do you trade, that matters much more.
Sure. Yeah, I'm not surprised by you saying that. I think that's also our own kind of view on this. I want to set the scene a little bit for the next question for those who may not yet have read Andreas's first book called Following the Trend, which I highly recommend. Actually, just for you to know, Andreas, it's usually when people ask me what book should I read, and obviously you don't want to give them a list of too many to start out with, but I would say actually yours is one of the first ones I would mention because I think it's incredibly practical, and as Jerry was saying saying what he liked about the book was also the fact that you compared what you called a core strategy to some of the largest managers in the business. So let me just, for the audience at least, set the scene and talk about what that core strategy was, because it was relatively simple. One, you would pick a universe of about 50 markets, I believe, and you would divide them into 5 sectors. I'm not so sure whether whether there was any benefit. I can't remember now whether the sectors meant anything or whether you would just risk the same amount of market risk per market regardless of the sector. But then you would go on and say, okay, let me put in a simple filter for the signals. So you for long trades, you would want the 50-day moving average to be higher than the 100-day moving average, and then you use a relatively simple kind of 50-day breakout model, buying 50-day highs, selling 50-day lows, etc. You would use a relatively low risk per trade. There was some ATR, average to range based position sizing, and you would have a relatively simple stop rule. So if you were long and the market had moved up, you would basically get out if the market moved 3 ATRs away from its highest closing price since the position went on. So something I think a lot of people can get their head around. And then you went on to show how this strategy would compare to, as I mentioned, some of the best managers in the world, and the strategy compared very well. Again, I don't remember if you were comparing gross return from the strategy versus net returns of the managers. I don't know. Doesn't really matter. The point is, it was doing really well. My big complaint about it, Andreas, is that the book was written as 8-9 years ago, so the whole experiment stops in 2011. We just don't know what happens after 2011. So I was curious to know whether you had any suspicion, maybe you actually kept running this model from time to time in your own spare time. But I mean, there's been a lot of focus on precisely the last decade. You know, some people might even call it the lost decade for trend followers. So I'm curious to know whether you think this relatively simple approach actually have continued to do well, either in its own right, but also maybe even more interestingly, how it would have continued to compare to the managers you were using in this little experiment.
First of all, the cost of things were included. I loaded a 2 and 20 cost structure on the strategy as well.
Cool.
So that was in there. But what happened since? Well, there's some problems with comparing with the funds going forward. And of course, first of all, thank you both to Jerry and to Don for not suing me for putting their track record in the book and comparing them. I'm sure I might sound funny to you guys, but I actually took steps to make myself very expensive to sue over that in case somebody really got offended. But as it turns out, that was wasted money on my part because nobody ever tried. But I hardened my structure a bit before that just in case. So what happened after? Well, the strategy has done okay, I'd have to say. Not stellar, not super. It's done okay. It's in line with the business. But the problem is this, that the business is changing. I mean, how many pure trend followers do we have anymore? Not that many. You know, a lot of people, a lot of the funds started going into more and more, well, other things. They started diversifying, they started adding sub-strategies, which grew in allocation. And that's always a conversation I have now when I allocate. If I put on my other hat for a while, the allocator hat, sometimes I would be looking for a pure trend follower because I want to have a building block. I just want to allocate money to trend following. And I get managers with a good track record saying that the great part is that now we only have 50% trend following and we have all these other things in there. And yeah, great, but you know, now it's not pure trend following anymore. And that's what I actually wanted in this particular case. So the problem is comparing many of the ones I mentioned as well they have morphed over time. As usual, I hate to mention any particular one because there might still be somebody out there who lacks a sense of humor about being mentioned in these kind of books. So comparing it's difficult, but to be honest, in the past 5 years or so, I haven't followed up I haven't done a correlation analysis in quite a few years on this book. Maybe I should do that. I had some requests to do an update of more than once.
Yeah, I know that Meb Faber was also mentioning that because I was listening to your interview with him as well. And, probably it's not worth to write a whole book about it, but I think a little paper updating this. And you're right. I mean, some of the names mentioned in your book, I wouldn't consider them as pure trend, or at least they have another strategy now that they would say is their pure trend, and then they have their original program. But I mean, some of them I would still say are pure trend, and some of them once you get to know a little bit about their strategy, actually, at least one of them that springs to mind is not very dissimilar to your core strategy. So, of course, as trend following geeks as we're of course interested in this stuff. But yeah, I've got a bunch of questions, but I'm gonna let Moritz jump in here because my next question is in on a different topic. So, Moritz, if you wouldn't mind.
Yeah, sure. Happy to jump in again. Andreas, I want to come back to the topic of diversification, and you and Jerry, you spoke about the stocks, and I guess if I were just for a second assume I'm working for a firm that only allows me to trade stocks, right, and no other asset, only stocks and equities, and if that were the case, then I'd say, well, I'm going to trend follow the stocks as opposed to trading them long only buy and hold, because long only buy and hold comes with really terrible drawdowns, and the Sharpe ratio of a long only buy and hold equity strategy, if you want to call it, is probably worse than if you apply trend following techniques to it. So, but then assume that all of a sudden you're allowed to trade more than the equities, and all of the asset classes are opened up to you. How do you then go about diversification in a trend following portfolio? I mean, how do you build the thing? How do you decide on the number of markets, and how do you decide which markets you're going to be trading?
Well, you figure out first what you want to accomplish. In my view, I mean, it's a problem, of course, if you don't know where to start, then you probably start with the mindset of, well, I just want to make money. But it's not that simple, is it? I mean, you're looking for some sort of return profile. At least if you do this for a living. If you're on the professional side, you're just not looking for profit. You're looking for some sort of return profile. It's very, very unusual for somebody in the business as an employee of some investment firm to just get a brief of just go out and make money. You probably have a specific brief you need to follow. What kind of returns from what? What kind of correlation to whatever? What kind of volatility patterns are we looking for? But on the future side, though, I mean, if you now have no constraints whatsoever, on the future side, the nice part is, well, good and bad, that there's a limited number of markets you can consider to begin with. It's not like stocks, when you have tens of thousands of stocks to pick from. It's not that many futures really you can trade. So you can pretty much include all of them, because they're not all going to give you a trading signal on whatever model you're running anyway, right, at the same time. So most likely, if you have a decent amount of capital to trade, and your example is a professional, so probably does have that, trade all of them, apply it on anything that's of interest, anything that's liquid enough. And you're going to find that once you start narrowing for liquidity and so on, you'll end up with, well, depending on your criteria, between 50 and 100 different markets, and that's it.
Yeah, right. But, now you're trading the 5-year notes and the 10-year notes at the same time, and they're very highly correlated most of the time, as are heating oil and crude, right?
Yep.
And so if the rule is to just say, let's trade all the markets, and, that may not be the right thing to do. See what I mean? From a risk-adjusted return point of view.
Well, that depends on what kind of allocation model you have, right? I mean, if you have a very simple approach to risk or to allocation, and you might just see every position as an independent item in a vacuum, right? And in that case, absolutely, you have a point. You can't just, if you have one risk unit, however you define that, and you take one risk unit per position, sure, you have a big trend in treasury markets, and now you're long all of them, right? If you have a more complex risk allocation model, you probably have some sort of covariance matrix involved. You have some sort of restraints on different themes. In that case, trade all of them, because once you're long crude oil, you get a signal to go long heating oil. That signal will also tell you to reallocate and to change the allocated amount to each one. Either that, or, which I also don't have a problem with, I am actually I actually see a benefit on the completely opposite way of looking at it, as in, if you have no restraint at all, and you just take all of them, so you take all of the treasury positions at once, you have a massive risk in treasury, you have a big corner risk, right? But in the end, a large part of the gain in trend following per se comes from corner risk, from concentrated risk. So here's something you've got to decide for yourself. What kind of risk do you want? If you're happy to take the extreme concentration risk and go for the big bucks, sure, go for that, as long as you're aware of it. Or if you're more concerned about keeping the volatility on a certain level, you're keeping your overall return profile on a certain level, well, then you need to take into account that positions are similar and scale down the other ones, right? It all depends on what you're looking for. There's no right or wrong in my view. There's no, this is the right way to do it.
Okay. Cool. Jerry, what's on your mind now?
Well, another crazy idea that I have, and we talked about this on Meb's podcast, and I was really interested in all of this, and I love your quote here, and it was, put all your money in trend following? No, don't put all your money in anything. Equity markets are still one of the worst asset classes. If you look at the volatility-adjusted returns, it's still one of the worst looking ones. So my idea, though, is that, yes, you put all of your money in trend following or systematic trading, and but because I agree, equity markets are one of the worst asset classes, but it's the worst asset class because it's not wrapped in trend following. You don't take small losses. You don't have a systematic rules-based approach. You don't have a exit strategy. You're just long. And so what's wrong with searching the world over for hundreds of, or as many as possible, currencies, commodities, stocks, bonds, long, short, massive diversification, lots of single names, stocks or indices that are different, and wrapping it up in this risk control, in this capital preservation thing we call trend following. And apart from buy and hold being, over the past 10 years, the greatest investment of all time, but I think you may sort of say at this point in time, well, I don't know if I can really rely upon that. I think I'm going to rely upon this idea that it's still one of the worst asset classes. If volatility adjusted, we're going to have the 50, 60% drawdown. So what's wrong with not trying to find more securities and crazy and OTC markets or whatever? Just make it your life's mission to have as much diversification with shorts, and utilize systematic trend, long, medium, short, whatever, and in this way to build this portfolio that is the safest thing possible and that doesn't suffer from, because anything without trend following, long only, could possibly be the worst asset class out there, because that's really the problem with stocks, is that there's no trend, there's no capital preservation.
I'm a very big believer in diversification on all levels, not just on the trading strategy level, but diversification between strategies, between investment products, between anything really. Probably because I just don't like losing money, not big anyway. I mean, losing money is part of the game, but I don't want to be personally, I would never want to be in a situation where I have a theoretical loss of, say, losing half my net worth in a year. I don't want to have the theoretical possibility. I think if you invest in one single thing, I mean, no matter how good that is, you find a brilliant trend model, you're applying this on a large number of markets, you're seeing excellent returns over the years, it's one model. And you might still get this 40, 50% loss. Now you lost half of, you might. I'm saying it's not possible. It's not impossible. I mean, if you find a model that produces excellent returns without drawdowns over long term, that's absolutely brilliant and more power to you. But I haven't. I found models that produce good results, but they have good years, they have bad years. I have friends and colleagues out there running different type of models that I don't have the knowledge for or the capacity for, and I'm very happy to allocate to them. So for me, my point of view is I'm doing my best with what we're managing. but I also recognize we can't do everything, and other people do great things. I'm happy to give guys like you, Jerry, some allocation, because you can do stuff that we don't want to be doing. Overall, my overall return curve with everything in it would probably look better in the long run with lower risk, because totally different approaches.
Oh, one final. I'm sure you've seen the research. There's been a few papers out, AQR research. We're all big fans of AQR and Cliff and their contribution, thought leader. I think there's been other research as well that's been put out there about trend following over the past 10 years. And according to the ones that I've read in AQR, it's the underperformance of CTAs, to the degree that there has been any, is totally due to the lack of big trends. Did you agree with that, or is that have you done research that confirmed that, or do you think it's worse than that for CTAs?
I mean, I see the biggest problem is for me the biggest problem with trend following. And don't get me wrong, I am a big fan of trend following, but clearly we have seen that trend following returns have gone down the last, say, decade compared to a few decades before that. I think, for me, the biggest issue is the interest rate environment. The trend following benefited massively, and rightly so, by a high interest rate level that was slowly declining. One, because of obviously the return on free cash, but more importantly by riding the long bond trends. Bonds obviously going up when yields are going down. So that trend was hugely important back then. I think trend following is doing just fine without it, but I wouldn't expect 1990s kind of returns, because there was a whole different type of environment. That, and one thing that I have no real scientific backing for this one, but in my view, one problem is this event-driven world that we ended up in. We have a much more concentration risk on single points in time. We had slightly easier here the past couple of years, but we had some years where it felt horribly, because all the time there was a single point in the near future that everything depends on, be it a US debt ceiling discussion, or these kind of big things. There were referendums, there was a Brexit, there was US presidential elections. There was one point in time where everything turns up or down on news coming out, and we got this increased correlation around these points. I think trend following was a bit hurt on that. I see that as having eased a little bit recently, but globalization, that's what we get, right? You go back, 40 years, you probably didn't have the same problem with this global phenomenon. No, lack of trends. I mean, we had many great trends. From a purely non-scientific point of view, I don't see that issue. Then again, I'm not really going to go out there and argue with Cliff and these guys. I think they say something, I can disagree with them on a podcast. If I get in the same room, I'm going to tell them how impressed I am by the research.
Exactly.
I think we all feel that way. But I mean, just on that point, just before I dive into my set of questions, Andreas, I mean, I think those points you mentioned about, the world is moving so fast, there's a lot of quote-unquote event risk, there's news flows, and I think there's a big article out in February of 2019 declaring really trend following dead yet again, and they came out with all of these arguments. And actually, a lot of the arguments have persisted through 2019, but yet 2019 was a great year, the best since 2014. So I'm just very cautious about declaring anything not working. And I think, of course, I mean, maybe... And actually coming back to your previous point, Andreas, about not being afraid of concentrated risk in a portfolio, I think that's so true. I mean, why we should, because concentrated risk in a trend following portfolio, it's a way to express conviction, right? We have conviction in those trends right now. That's why that's why our risk budget is allocated in a certain direction from time to time. And if you go back 40 years or 45 years, if we look at our 45 years of history, there's been plenty of times where we've had concentrated risk because that's where the trends were. No, I would caution about that, and I actually don't particularly think that and certainly we haven't seen it on our side necessarily that the last 10 years has been dramatically worse than previous. I accept the 90s were really good, but who's to say that we can't have that the 20s won't be really good? I mean, if people looked at equity returns after 2010 for the previous decade, they wouldn't be too excited. Now they look at them and they're thrilled, right? So I think it's tough. But anyways, I want to go in a completely different direction, and again trying to distill some of the questions we've had over the past year and a half on the podcast, and this is to try and help people understand maybe some of the finer details in terms of backtesting, but again keeping it on a, I think, hopefully relatively simple level. I want to ask you, and I know you've done some work on this in your latest book, so I'm not, and unfortunately, admittedly, I haven't read your latest book yet.
What?
But what? Yeah. But I'm sure you can give us some really good points. So let me break it down very simply. First of all, when you have to select your parameters, whether it's a pure trend following system or another sort of systematic approach, you obviously have to make some choices in terms of parameters. So my first question to you is really, are you a fan of always keeping parameter selection universal to all markets? Or do you think applying certain parameter combinations to a group of markets, or even down to a point where you say, actually, I'm going to choose certain parameters only for this market, but of course I'll choose more than one combination, so I want a bit of diversification. I mean, where do you sit in terms of, should we do everything the same across all markets, or should we do acknowledge that some groups of markets have maybe different behavioral ways of trading, or even down to the single market? Can you successfully apply individual parameters to a market without, of course, as we know, the risk of overfitting?
Well, first I think that a really stable model, a robust model, can work fine on the same parameters on almost anything, if it's a robust model. But I think there are sometimes cases for doing something different. The danger, in my view, is doing something different based on your subjective views. I mean, your experience that, say, I don't know, corn behaves differently, so I need to have a different parameter for it. That can be very dangerous. I think it's much better in that case to quantify what does different mean. What is it? Is it because of different term structure? Is that perhaps why you think it's behaving differently? Or is it a volatility pattern, or what is it? Maybe you can implement this or incorporate this in your rules. So instead of setting a rule saying, if the market is named the following, then trade differently, I think that's dangerous, but more of, if the market has the following mathematical properties, then we adapt something, which is, in my view, more robust, because the behavior, whatever it is that you have in your mind that is different with a certain market, can come and go, right? They can change. So your memory of...
I was referring to being different in saying that if you use just one set of parameters across a whole portfolio, obviously some markets will do well, but then others you'll see, well, actually, they don't really cope very well with these kind of parameters. That's what I meant. I didn't mean that I was making a call on, I think corn is different. I mean, who knows what it is, but the data will tell me that it seems different. That's what I meant. Yeah.
I mean, that's all part of the usual follow-up process, right? I mean, if you get results you don't expect, you need to reevaluate. Is this normal variation? I mean, is this just normal behavior that you got bad performance on some markets? Yeah, it happens, right? Or did you fundamentally miss something? Has something changed, or did you make a mistake somewhere? That's a tough part of the process, right? Reevaluating, because what is it? The old expression of rule one: never change your rules, never break your rules, right? And rule number 2 is know when to break your rules. It's impossible. Clearly, having a dogmatic view of never change your rules, it's probably not going to work out for you in the long run, because sooner or later a situation comes along that it was just impossible to foresee before, right? I mean, sometimes you have to adapt. Like if you had a model that say was trading Swiss franc against euro, what was that now? Is it 4 or 5 years ago? I forget, when the 1.2 level broke. if you had a trend model that told you to be in that position at that time, you probably wanted to override it. And these situations, backtesters don't know about these possibilities. So reevaluating is difficult. And
sure,
yeah,
sure.
Sorry, bad answer.
I think no, that's fine. And I think another question that a lot of on people's mind, and that is again, and we certainly obviously had some more discussions when we had our live event in New York last year with a bunch of people, great guys who were building their own trading portfolios now, and then some of them were already up and running. I mean, the next kind of philosophical question would be to say, well, let's just say you have your 50 market portfolio and you have 20-25 years of data in this case, and let's just say you want to apply universal parameters to this universe of markets. But what if you see that there are 2 or 3 markets that really hasn't made no money or consistently loses money? It just doesn't work. I mean, are you of the thought and say, well, then just take them out? Or are you in the camp of saying, well, we have no idea what's going to happen in the next 25 years, so we need to keep them in? So where do you sit on that?
Can you figure out why they don't work? Is the first thing I would look at. I mean, is it just something random? Or is it some property of these markets that make them not work? I mean, sometimes it could be real world things. I mean, if you're looking at, something like star markets where you have some natural barriers and natural behavior, or you're looking at something where, I keep mentioning, I'm a big fan of looking at term structure for analytical purposes, but maybe there's something in there that's a problem. But if you can't explain why it doesn't work, it just doesn't work. It's a difficult one. Then it's a very subjective call to just take it out because the backtest didn't work. That can backfire. I mean, that thing that performed brilliantly for 25 years in the backtest, that might be the worst performance for the next 10 years, right?
In terms of backtest, what nowadays, when you look at these things, do you look at data as kind of pre-crisis, post-crisis? What's the minimum amount of data you want to run a backtest on to feel that you kind of have kind of quote unquote seen it all? I know there's a limit to how much data at the end the futures markets will give you, but I mean, do you rely more on recent data? Some people I've heard prefer that and is less worried about data from the 90s and et cetera, et cetera. What are your thoughts on these things?
This is in my view, a very complicated subject. The problem is, theoretically, as soon as you backtest on a set of data, you have now diminished the value of that data. Right? I mean, you run your backtest in the last 10 years of all your markets. You run your backtest on all the data you have, right? Now you have reduced the value of the data you have. And that's the problem, how to get past this issue. Because the next time you run a model, next time you design a model, you're going to have in your head, in your mind, you know what the markets are, what worked and what didn't. Now you already have a bias in your backtest. Now when you design your hundredth model, you have already implicitly curve fitted it to the data you already knew. This is a very difficult subject, and I think if we get 10 PhDs, data scientists in the room together, they could have an argument the whole day here while we eat popcorn and watch. What do? Well, I try to apply reasonable amount of caution in how to use the data, backtest on small amounts, use other data chunks for verification. The reason I normally don't mention this stuff in my books is because it's a big topic, it's a complicated topic, and quite frankly, it's a boring topic. We all want to do the same thing, right? What we want to do is we want to test a model on the last 40 years of data, update it 10 times until it works, and then call it a day and say, now the model is great because look at my backtest. But that's not going to work out for you. Because now you have already fitted it so much by knowing in your head what's going to happen, right, and updating the model. No, you have to backtest on smaller amount of data. The problem is that we don't have enough data in futures world, so that's clearly a big issue.
Hopefully a slightly different question. Would you recommend right now, 2020, for CTA trend following, to use the whole 40 years, or the markets have changed so much and the world has changed so much, let's look at the last 10 or 15 or even less. So at what point do you sort of say, hey, I love this large sample size. I haven't tortured the data too much. I haven't contaminated it too much, let's say. But regardless, yes, continue using 40 years or as much as you can get your hands on, or no, let's sacrifice that because computers and too many trend followers, and we need to concentrate, accept a lower sample size of trades historically and concentrate, because the data, the more recent 5 or 10 year data is more relevant.
I say that more recent data is more relevant, but we also need to understand how it behaves in different type of market regimes and market environments. And in the last 10 years, we just had the longest equity bull market in history, and that's not going to happen in the next 10 years. So if you just look at the last 10 years of data, is it likely that we get 10 more years the same as the last 10 years? I'd say that's not terribly likely. So you have an issue there, right? And even worse, we have a new generation of analysts and quants out there building models who only have experience the last 10 years. We have a whole new generation of people in the business who simply cannot conceive the idea that stocks might actually not perform in the next 10 years. And that's an issue. I mean, I'm mentioning stocks because we all know that stocks have a major impact on everything else in the long run, right? Whether we have an equity bull market or bear market will impact the performance of good or bad, but it will impact the performance on everybody on everything else in conjunction. No, it's more important, but we have to look at everything. You have to look at different market periods, high interest rates, low interest rates.
So just as we were getting into the details with Andreas on this point, we actually lost the connection for some reason. And so rather than you waiting for us to potentially recover those files, I thought I would jump in and just let you know that we're going to have a little bit of an abrupt ending to this week's episode. But of course, we will try and recover the full part and publish that as part number 2 with our conversation with Andreas Clenow, as we got into many more good subjects, I think. For this week, let me just say that the BTOP 50 index is up 0.89% for the month of January, which of course also is the year-to-date number. Same for the SocGen CTA index. The SocGen Trend Index up 1.14% for January so far, whilst the short-term traders index is down 31 basis points, and the Bridge Alternatives Index is up 0.75% so far. So we're going to wrap up this week's conversation a little bit abruptly. Apologize for that. We'll hopefully have this all sorted out in the next few days. But in the meantime, from Andreas, Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on